So in this video, we're going to look at what do we mean by the money supply and what is this idea of liquidity. We'll start off with liquidity. What is liquidity? It simply means immediate purchasing power without any capital loss. So probably the most liquid thing you have is cash. With cash, you can immediately give someone some cash and buy something. So pretty well has all the functions of money. As we go along the liquidity spectrum, we gradually move away from the functions of money. As we go along this line from left to right, the functions of money significantly decrease. So the function as a store of value or a medium of exchange. So let's look at the liquidity spectrum. If we start off with cash, this is probably the most liquid we can get. Then we've got debit card payments from current accounts. But these will pretty well act like cash. So if you use your card or your phone to pay for something, you can do it pretty well instantly. So you can have immediate purchasing power and you're not going to have any capital loss and there's no time loss. Okay. However, imagine you had a savings account. You might have a savings account because it gives a high rate of interest, and we'll look at that in the banking video, but these are sometimes called time deposits. Should these be included in a definition of money? Because you can probably move the cash, well, you move your savings into a debit account, a credit card, a current account pretty quickly, and then buy something. Or can you? Because they're often time limited, aren't they? So you might have a 30-day, a 60-day, even 120 days before you can touch those savings and actually go and buy that ice cream or car or whatever you want. So the longer the time on the deposit, the less liquid it is, of course. And then we have assets such as treasury bills. These are very short-term, very short-term IOUs in the government, and we have bonds. Slightly longer, and again you could probably sell those and get purchasing power quite quickly, fairly quickly, but not necessarily such a guaranteed amount. Right, and then we come to physical assets such as property, cars, paintings, jewellery. I mean, to what extent, if you had a wonderful Rembrandt self-portrait, one of the greatest artworks in the world, would that be money? Clearly, it doesn't really have the functions of money. So see the video on functions of money, by the way, if you're not too sure about that. So it would take quite a while to sell the Rembrandt, and you weren't necessarily sure how many millions you'd get for it when it goes to auction. So therefore, it doesn't really behave in terms of money, in terms of the functions of money. Okay, so this is it's good to think of this as a liquidity spectrum. So when we come to looking at the money supply, we need to think of this idea of liquidity, because the money supply is basically the total amount of money in circulation in the economy at any one point in time. However, how do we define money? Because we could either have a narrow definition of money, and if we have we have a broad definition of money. Okay, so on the board, these aren't motorways in Britain like the M2, the M4. They're different definitions of the money supply that the Bank of England has, and different central banks have different definitions of the money supply. So what do we mean by narrow money? So narrow money in Britain is maybe represented by MO, and it's primarily used as a medium of exchange. In terms of MO, what we're talking about are notes and coins, and reserves of banks at the central bank, or the Bank of England in this case. So that would be a narrow definition of money, and basically it's financial instruments, obviously notes and coins, but are very liquid. However, couldn't we also include bank accounts? And if we include bank accounts, could we not include savings accounts? Because they're very much like money. And so therefore we move to a broader definition of money. So broad definition of money is what you might call narrow money plus near money. So definitions such as M4 in the UK would include not only narrow money but also bank account deposits. And therefore, there's a lot of discussion, and it's quite arbitrary really, about how we actually define the money supply. But I hope that was useful, and thank you for watching.